and Turkey, reflecting the adverse effects of the recent financial turmoil triggered by the strengthening US dollar and other geopolitical factors. Global inflation remained relatively stable through the year. In advanced economies, headline inflation was largely contained around the 2% target in the last quarter of 2018, while core inflation remained subdued. Among emerging market economies, inflation was fairly well anchored, partly reflecting the recent decline in international crude oil prices. The growing uncertainty in global growth could result in a slower than anticipated normalization of monetary policy in both the US and the EU, as well as in China in 2019. It is also expected that external financing conditions, especially for emerging markets and frontier economies, will continue to be tight. On the domestic front, the disinflation process continued in 2018. Headline inflation trended downwards from 11.8% in December 2017 to 9.4% in December 2018, remaining broadly anchored within the medium-term target band of 8 plus or minus 2%. This has been supported by the relatively tight monetary policy stance maintained throughout the year. Underlying inflation pressures are similarly well contained, as all the bank's measures of core inflation point to a general easing, and further underpinned by well-anchored inflation expectations of both consumers and businesses. Developments in the real sector indicated firm growth rates in 2018, although at a slower pace compared to 2017, but in line with projections made at the beginning of the year. Real GDP growth in the first 3 quarters of 2018 averaged 6.1%, compared with 9.1% for the same period in 2017. Similarly, non-oil GDP growth averaged 5.9%, against 6.1% over the same comparative period. Overall GDP growth for 2018 is projected to expand by 5.6%. The bank's composite index of economic activity also picked up, although at a slower pace than in 2017. The CIEA recorded an annual growth of 3.1% in 2018, compared with 8.3% for the same period of 2017. Notwithstanding the developments in the CIEA, evidence from the business and consumer surveys showed some rebound in confidence and optimism about performance of the domestic economy. Price movements in the international commodities market were mixed in 2018. On a year-to-date basis, crude oil prices rose by 25.4% to an average of $80.6 per barrel for the period ending October, due largely to supply cuts amidst geopolitical factors and other output disruptions. However, prices fell sharply in the last 2 months of the year due to global growth concerns and improved supply. The year ended with an average price of $57.7 per barrel. Gold prices remained relatively stable for the 12-month period to December 2018, averaging $1,251.1 per fine ounce, on the back of a strong dollar, the hawkish Fed stance, and stronger U.S. economic growth. Cocoa prices bounced back strongly, supported by reduced output in West Africa due to hot weather conditions as well as increased demand. Cocoa closed the year at an average price of $2,256.3 per ton, representing an annual growth of 18.5%. As a result, the trade balance recorded a larger surplus of $1.8 billion in 2018 compared with a surplus of $1.2 billion in 2017. This translated into a further narrowing of the current account deficit to 3.2% of GDP in 2018 from 3.4% of GDP in 2017. The current account outturn, together with the lower net capital inflows, resulted in an overall balance of payments deficit of $671.5 million for the year 2018, compared with a surplus of $1.1 billion in 2017. Consequently, the gross international reserves declined from $7.6 billion, that is 4.3 months of import cover, at the end of December 2017, to $7 billion in 2018, that is 3.7 months of import cover. The global financial developments, in particular the strengthening of the US dollar and increased risk aversion, adversely impacted currency markets in emerging market and frontier economies, including Ghana. In addition to increased domestic demand pressures, the cedi cumulatively depreciated by 8.4% in 2018, compared with 4.9% in 2017. However, the cedi depreciated more moderately against the pound and euro by 3.3% and 3.9% respectively, compared with 12.9% and 16.2% depreciation in 2017. In trade-weighted terms, the real effective exchange rate remained aligned with the underlying fundamentals. The performance of the budget based on preliminary banking data indicated an overall deficit on cash basis of 3.8% of rebased GDP in 2018. Total revenue and grants amounted to 42.3 billion cedis compared with the program target of 45.8 billion cedis. Total expenditures was 53.7 billion cedis, marginally below the target of 53.8 billion cedis. The deficit was financed from both domestic and external sources. The stock of public debt at the end of November was 57.9% of GDP, compared with 54.5% of GDP in the same period of 2017. Of the total debt stock, 9.8 billion cedis represented bonds issued to protect depositor funds. The external debt component was 86.3 billion, with a share of 49.9% in the total debt. Growth in monetary aggregates has generally slowed in the year, consistent with the disinflation process. Annual growth in broad money supply remained broadly unchanged at 16.5% at end December 2018, compared to 16.7% in the same period of 2017. The moderated pace of growth in total liquidity reflected sharp contraction in net foreign assets of the banking sector, a departure from the net domestic assets-driven growth last year. Annual growth in reserve money slowed sharply to 4.6% in December 2018, against a 13.2% annual growth in the same period of last year. Private sector credit growth, on the other hand, continues to recover following the sharp dip to 2.4% in March 2018. Annual growth in private sector credit for 2018 was 10.6% compared with 13.4% growth a year earlier. In real terms, private sector credit expanded by 1.1% in 2018. The latest credit conditions survey showed a tightening stance on loans to enterprises during the last 2 months of 2018. However, the survey results project an easing of banks' credit stance over the first quarter of 2019, in line with their enhanced capital levels. Developments in the money market reflect an upward trend in interest rates at both the short end and medium-term segments of the market. The 91-day Treasury bill rate moved up to 14.6% in December 2018 from 13.3% a year ago. Similarly, the 182-day instrument increased to 15% from 13.8%. Also, rates on the secondary bond market have increased significantly, reflecting tight financing conditions. The yields on the 7-year, 10-year, and 15-year bonds jumped to 21, 21.2, and 21.4% in December 2018, from 16.3, 16.7, and 17.2% respectively a year ago. The weighted average interbank lending rate, that is, the rate at which commercial banks lend to each other, however, declined to 16.1% in December 2018 from 19.3% same period last year, reflecting the monetary policy stance. Similarly, average lending rates of banks also declined to 26.9% from 29.3% over the same comparative period. The recapitalization exercise ended in December 2018 with a total of 23 banks meeting the minimum requirement. These banks are sound, liquid, and well capitalized, and well positioned to translate the gains made so far from 2 years of far-reaching reforms to the rest of the economy. At the end of December 2018, total assets of the banking sector grew by 14.7% year-on-year to 107.3 billion cedis. Going forward, growth in industry assets is expected to rebound as banks deploy their newly injected capital towards financial intermediation. Key financial soundness indicators have also improved. In particular, the industry solvency, measured by the capital adequacy ratio, has increased to 21.9% at the end of December 2018, significantly above the prudential requirement of 10%. Asset quality also improved, with the non-performing loan ratio declining to 18.2% from 21.6% over the same period, and largely reflecting implementation of Bank of Ghana's loan loss write-off policy. Other key financial soundness indicators remain positive and are projected to improve. To summarize, the committee observed that the year 2018 ended on a solid note with a more consolidated banking sector, as weaker and undercapitalized banks that pose risks to financial stability were removed. This enhanced the efficiency and profitability of remaining banks and has restored confidence and resilience in the banking sector, with the banks now better positioned to support private sector-led growth in the Ghanaian economy. The clean-up exercise has also protected deposits of over 1.5 million depositors, with deposits of 11.6 billion cedis. This includes deposits of savings and loan companies, rural and community banks, investment fund managers, pension funds, and life insurance companies with the banks. Looking ahead, there will be a need to focus on reducing the high NPLs in the sector and addressing the risks associated with a high degree of interconnectedness in the financial system, which will require close monitoring to ensure financial stability. The committee noted government's decision to create and strengthen institutions to provide the needed structures to underpin the commitment to fiscal and financial stability as Ghana concludes the IMF-supported ECF program. In particular, the passage of the Fiscal Responsibility Act and the establishment of the Fiscal Council, the Financial Stability Council, as well as the reconstituted Economic Policy Coordinating Committee should anchor fiscal policy and help entrench the macroeconomic gains achieved over the last 2 years. The committee also noted that external financing conditions remain tight and uncertain, presenting financing risks to the budget with implications for the exchange rate. This calls for a recalibration of the financing policy mix towards more domestic financing by domestic investors to reduce the burden on the exchange rate, reserve accumulation, and monetary policy. The committee also observed that domestic growth remains fairly robust and in line with projections. Over the medium term, growth prospects are positive and would be supported by increased oil production and the easing of the credit stance. With the recently ended recapitalization, banks are also better positioned to support economic activity. The committee also noted that inflation has steadily declined from 15.4% at the end of 2016 to 11.8% in 2017 and further down to 9.4% in 2018, supported in large part by non-food inflation. The bank's latest forecast shows that inflation will remain within the target band of 8 plus or minus 2% over the forecast horizon, bearing any unanticipated shocks. The committee noted that the immediate risks to the disinflation path are well contained, and the current conditions provide scope to translate some of the gains in the macroeconomic stability to the economy. Under the circumstances, the committee decided to reduce the policy rate by 100 basis points to 16%. Thank you.
Thank you very much, Chairman. Thank you. It's question time, so kindly identify yourself. And the media house. All right, Toma.
Good morning, Governor. My name is Toma Imiri. I'm representing Go Street Business. Two quick ones. First of all, I can understand why you have monetary policy which is actually encouraging reduction in lending rates, why treasury rates are going up in order to defend this CD. But in your opinion, don't you think this will encourage banks, even with their new financial strength, to increase the size of their investment portfolios against their lending portfolios? You have a situation where loans are cheaper but harder to come by because banks are putting their money into treasury rates, which right now even short-term rates are getting quite close to the new monetary policy rate, which has been reduced. That's one. The second is it relates to GATT. So we still need to know certain things about the situation with GATT. First of all, the 5 beneficiary banks currently pending the negotiations going on between GATT and the private pension funds. Don't we have a situation where those 5 beneficiary banks and some of the banks that are about to be acquired, about to finish their merger negotiations, do we have a situation where they are currently operating in the market with minimum capital of less than 400 million. One, and the other thing, the last thing is, under the structure of GATT, where they are supposed to, where bonds will be issued to GATT, does not amount to debt financing for recapitalization of those banks. Thank you, sir.
Thank you. Good morning. My name is Melvin from Daily Guide. My question has to do with the position of Heritage Bank, the defunct Heritage Bank, sorry. One of the major shareholders, Seidu and Agongo, is raising concerns that he was unfairly treated by the central bank, and that during his meetings with the central bank, there was no point in time where he was told he was unfit to be a major shareholder in the bank, only for him to notice later on that the discussions he had with the bank went contrary to that, and then could not and allow the bank to remain in operation. So I don't know what you have to say about that. Daily Guy, Melvin. Daily Guy.
Okay, good morning. My name is Richard Ni Anekweabi. I write for the Business and Financial Times. I want to find out from you. We know BOG has some shares in NIB, and with it coming in place of GATT, what would be the impact? Is BOG diluting its shares if GATT finances the capital requirement of NIB? How is it going to play out?
My name is George Yafe from Joy FM. First is on the CD. There's been calls that some of the businesses that we engage are saying that, can we have a kind of a fixed rate that they will know that for the next maybe 5 months, maybe the CD will be $5 to $1 or something. What do you make of this proposal? Because they are worried about the blips. And why is the Bank of Ghana not on the market in terms of supporting these commercial banks to help deal with this problems with the CD? Also with the NIB, so what happens next after the advisors' work? Are we still going to have some kind of support, or you're going to leave your interest to a strategic investor to come in? What is going to happen to NIB going forward to ensure that the bank is still strong and stable going forward?
Thank you. Max, come here. Come.
Hello, my name is Maxwell Adumbile, graphic business. Mine had to do with our international reserves. I've noticed that both the gross and then the net has witnessed declines from 2017 November to November 2018. And at a time that our exports did quite well, I think 13 billion to 14 billion plus. So what could have accounted for the decline in the midst of a strong growth in export? Are we drawing down to finance something? And then on your comment on the Fiscal and Financial Stability Councils, given that the Financial Stability Council in particular is more like a grouping of financial sector regulators, which in their independent way are supposed to be independent, and now you are bringing them together under this to come and advise the president, or let's say the fiscal sector implementators. Are we getting to a stage where you, the independent institutions, the heads are going to come together, advise the president to then advise you on what to do, which in a way will interfere with your independence? How are we going to work out that listen? Thank you.
Okay, one question from, okay, come closer.
Yeah. My name is Lawrence Egbefia from CTFM. There are concerns that with the Bank of Ghana and then the Ministry of Finance through government controlling over 90% shares in ADB, it has led to some inactivities of the bank on the stock exchange, and that it is time to offload, particularly the Bank of Ghana, to offload its shares to the public. Have you thought about that? What is your answer to that?
All right, thank you.
Okay, so thank you very much for these questions. Maybe I should start with Thomas' question on the monetary policy rate and what is happening to the treasury rates going up. I think that it's important to distinguish the various segments of the money market. So you have in the shorter term interest rates, these are the 91-day and the 182-day instruments, which are more closely related to the policy rate. And we think that that alignment between the shorter term rates and the policy rate is important to help in the transmission of the monetary policy rate. So that for me, it's a good thing if you are seeing some realignment of the shorter term rates getting closer to the policy rate. It means that the system is working, and that's what it should be. But you are right to also observe that the medium-term rates have inched up. And I remember in the statement, the numbers there were very clear. That obviously reflects the fact that that's the part of the market where non-resident investors are allowed to participate in. So when you do not have as much non-resident inflows of capital into that market, you would see that sort of development. So that the exchange rate risk, the developments in the frontier and emerging markets brought tightness to that segment of the market. And this is why you are seeing the rates for the 7-year bond, the 10-year bond, and the 15-year bond edging up. So all that is happening is very consistent with the developments in the broad macro economy. On GATT, I'm sure the ministry and the GATT themselves would come out and clarify many of the issues concerning GATT. I do not agree that the banks they are not operating with the minimum capital requirement. All the banks that are operating under GATT we consider as having met the minimum capital requirement. And the reason I know that is because I have certain undertakings, which I'm not going to disclose to you. I have those undertakings from the appropriate people to ensure that those banks meet the minimum capital requirement. As a regulator, we needed those undertakings in order to declare those banks as meeting the minimum capital requirements. Heritage Bank, I'm not sure we need to discuss that any further. I think the Bank of Ghana has been very transparent in all our actions. If you look at the press release that was issued, both for Heritage Bank and Premium Bank, we gave all the details on the reasons why they did not meet the 31st December deadline. There were more than 3 or 4 factors which were enumerated. They did not meet the minimum capital requirement. They did not attract private investors to bring in additional money to allow them to meet the 400 requirement, in addition to several other factors which did not make them qualify to continue to have that universal bank license. Now, this question about Bank of Ghana shares in NIB, those shares were bought back by NIB, I believe, about 3 years ago or so. So Bank of Ghana does not have any shares in NIB anymore. We can give you the details of that transaction, which happened under the previous administration. But let me spend some time on the exchange rate. I heard our friend from Joy FM saying that people would rather prefer a fixed exchange rate.
Kind of because of the fact that every day.
Yeah, so those are the questions, whether a fixed exchange rate versus a flexible exchange rate system would better serve an economy such as Ghana's. And over the years, we have agreed that the flexible exchange rate system better serves the needs of a country like Ghana and like Cote d'Ivoire or Senegal or those countries that belong to the safer zone where they have a peg arrangement with the euro. I think the important thing to note is that even though the cedi depreciated by 8.4%, if you compare it with the developments from other emerging and frontier markets in 2018, the cedi did really well. You take Argentina, where the peso recorded a depreciation of over 50%. Turkey recorded a depreciation of over 28%. Russian ruble, 17%. Even getting closer to Africa, Zambia recorded a depreciation of 16.2%. South Africa, 13.75%. So that's the context in which one can judge the performance of the cedi in 2018, that the 8% depreciation, 8.39% depreciation, compared to what went through other frontier markets, suggests that the Ghana cedi did relatively well. And that also, in a sense, the question about the international reserves and the decline in international reserves, both at the gross and NIR, which your colleague pointed out. Obviously, the central bank has to make a judgment. It's a question of how much depreciation relative to reserve accumulation do you want to achieve. These are the balancing acts. Given these external shocks that are coming to hit the economy, you need to make a judgment. A little bit of reserve reduction in order to stabilize the currency, but you also don't want to lose all your reserves in the process of trying to stabilize the currency. I think that the judgment that we made last year, because it's important not to unwind all the gains that we have done over the last 2 years. We spent 2 years bringing inflation down from over 15% to 11% to 9%, 9.4. If we allow the exchange rate to move too fast, you are going to negate the progress that you have made in terms of the price stabilization. So that's why you have to lose reserves to moderate the speed of depreciation of the currency. But at the same time, you also have to be mindful of the need to have reserves that are adequate enough to withstand further shocks. And I think this is the balancing act that the central bank has had to employ throughout the year 2018. So I hope that answers the question on the movements in reserves that you observed. The other question that I see here has to do with the Financial Stability Council and the independence of the regulators. You are right. I mean, we are not amending anybody's law, so the regulators will continue to be independent. This is really a forum for discussion, sharing of information, and knowing what is going on in each other's area, given the interconnectedness that we see between the banks, between insurance firms, between banks and other institutions, pension funds, and all of that. So it's important to have that council where the regulators can come together and see, how they can collaborate to enhance stability in each segment of the financial sector. So it does not undermine the independence of the institutions involved at all. The last question I have here is on the ADB and the fact that the shares there are not trading. That is to be expected. As you know, between the Bank of Ghana and the Ministry of Finance, we are holding nearly 90% of the total shares of the ADB. The plan is to offload these shares onto the market in the next 2 or 3 years. So that issue obviously is just a temporary policy, really. the government just stepped in, to ensure that the right things are done in terms of the way those shares were acquired. That eventually the shares will be uploaded to the market, consistent with the idea that privately owned banks perform better. And I'm saying this because of the question on NIB. NIB is a state-owned bank. Right? NIB is a state-owned bank. So one has to be conscious of the fact that it's a state-owned bank. It currently is operating as a universal bank. We have advisors going there to look at their operations. They may need to look at restructuring the bank. But I think they may even have to look at the model, whether the universal bank model can deliver the type of things that we want NIB to do. Maybe we may have to convert it into a development finance institution. And these are the big questions surrounding state-owned banks such as NIB. So that's my answer to the question on NIB.
My name is Etonam. I report for TV3 and 3FM. Governor, last week's report from KPMG indicates that it will be difficult to recover anything at all from the liquidated banks because most of their assets were overstated. My question is, where do we go from here? And a B to that, should we get to a point where we ensure that in recapitalizing, commercial banks write off their loans before they recapitalize so that we don't end up, piling up the NPLs, which is currently around 8.2% according to your reports? Because we know there's a correlation between capital adequacy and NPLs. Thank you.
Thank you very much, Mr. Governor David Hutton, RFI. May my best wishes for the year also. My question is on industry insolvency, which is 21+% now. Is it because we have a very high import cover for the first quarter that we've been able to see an industry insolvency ever since? And secondly, is the Bank of Ghana coming into the appointment of officials for the banks who were not able to come up with the minimum requirement and whose operations were seized? Are you appointing officials to operate these banks? Thank you, Maxi.
My name is Morris. I work with GTV. I want to know exactly how much of our foreign reserves was drawn down to support the local currency. We've seen about 600 million reduction. Are we supposed to say that the 600 million was used to support the local currency? Thank you.
Yeah, thank you very much, sir. My name is Justice. I report for Xinhua News Agency. I need a little bit of education on your NIB press release and then the response you've given here. What raises eyebrows for me is coming after the sector reforms that you carried out, then suddenly one of the banks you have supported with guts, goes under administration. Now, the question being asked is, why was this not done? What you expect the administrator to do, why was that not done within the period in which you were carrying out the, sector reforms? Now, going forward from NIB, you've said that history has shown that privately managed banks are doing better. If I heard you right, privately managed banks do better, maybe here in Ghana, Okay, but one wonders why that should be so, because the Bank of Ghana has issued a corporate governance guideline for the banks. Now, one would have thought that the state-owned banks will be used as models which the privately owned banks rather should follow. For instance, Ghana Commercial Bank, until it became a listed company, ADB, NIB, these banks have persistently had serious problems. Yes, please. Have persistently had serious problems, and one of which is leading NIB to where it is going now. Why can't these banks rather be the models for good corporate governance that the state wants to, ensure in the banking sector, and then also be used as models for? Oh. Now, okay, right, okay. It's a question, it's not a statement. I'm asking a question, so that these banks will also become models even for setting interest rates in the sector. But I have one more question, please. Is there, just a short question, is there a new forecast horizon for inflation? Because from what I know, the mid-term forecast horizon ended in December last year. Is there a new one? Thank you.
Governor, my name is Suleiman Mustafa. I write for the Daily Graphic. My question is a follow-up to Mr. GTV's, Mr. Pete's question on the reserves. Are we expecting some more inflows? Because we've drawn down some 600 million Ghana cedis, and there seem to be some drawdown. And I want to find out if there are some inflows that we are expecting. My second question, Governor, these are concerns that, are coming from industry players, and if you think that it will breach any confidentiality, please just ignore it. You've just confirmed that with the GATT, it was an undertaking you got from them. When are we expecting those undertakings to be actualized? If there are some timelines you can give us as to when they will actually support those banks to meet those capital requirements. Thank you.
Good afternoon. My name is Elon. I write for Economic Times. My first question has to do with the inflation target. You didn't give any time frame for this year, whether we are meeting the 8 ±2, first quarter, second quarter, or third quarter. Second question, I just want to find out whether our debt level now, whether it's sustainable going forward. Third question, the deposit protection scheme. I mean, in the 2019 budget, we hear it's going to be operationalized this particular year. When are we seeing that to be done? And whether we should expect other forest rules, especially looking at how our CD is performing now, whether those forest rules are going to be reviewed again or not. And more so, what reports are you getting from whether the Forest Bureau are submitting their reports to you with regards to the earlier forest rules that you issued during the last year? Thank you.
Okay, thank you very much for those sets of questions. KPMG, the publication of the assets and liabilities of the banks that were consolidated, that the assets were overstated. I don't know why they tied that to the ability to recover. I think that if you look at those statements, that tells you that when we went in there, if you would recollect, the initial estimate of the gap was smaller than what the receiver finally found out. That's all that it demonstrates, so that the size of the bond that had been issued needed to be revised in order to cover the difference between the assets and the liabilities of the banks that were consolidated. But in terms of recovery of assets, yes, maybe, I mean, in terms of the size it has gone down, but I know that the receiver is taking measures to try to retrieve assets, including fixed assets of the banks that were consolidated. So it might not be as pessimistic as the way you put it, that the receiver might not be able to recover any assets at all. Now, you tied that to the issue of recapitalizing before the loan write-offs. I believe this is because you believe that the write-off of the loans will eat part of the new capital that the banks have acquired. Yes, I agree with that assessment, and the issue of the correlation of the NPLs with the difficulties, that I think it's a fair comment. Nevertheless, the important thing to note about the NPLs in the system is that these are mostly legacy NPLs, and that means that over 50% of the NPLs have already been fully provided for, and the impact of capital in that sense has already taken place. So we have to bear that in mind. There was a question on the same, I believe it's the same NPL which you were referring to as insolvency, and I think I've addressed the question of the NPL. If you look at the fully provided for NPLs, the ratios really are closer to 10%. The underlying or the core NPL is closer to 10% than the 20% that is the headline number. Now, whether we are appointing officials to operate, we are not. And I should tie this question to the statement on NIB. It's not an administrator that we sent in there. I think that the press release was very detailed to provide the differences between an advisor and an administrator. If you recollect, that press release mentioned that the advisor was not going to take over management or board of the bank. The advisor was only going in there to advise the current management at NIB. So it's not an administrator that was put in NIB. We need to be very clear of the differences in that. And therefore, there's nothing wrong with sending an advisor to NIB post the recapitalization exercise. It's been a long intervention on NIB, GCB, state banks, whether state banks should be the model or whether private banks should be the model. I think we all agree that empirically state-owned banks tend to carry more baggage because they try to meet several objectives. They are not only meeting commercial objectives, they are also trying to meet, social objectives, and therefore they tend to have bigger problems. And the idea is that if we want the bank to be focused on setting objectives, maybe giving it a universal bank license may not be the way to go. And maybe making it a retail bank may not be the way to go. If you look at the new types of development banks that are being designed these days, they are designed as wholesale financial institutions that provide resources to be on-lent through more efficient financial institutions. So I think the whole model of development banking needs to be re-looked at if we want NIB to stay as a bank that is focused on industrialization and development for that matter. Question on the inflation forecast horizon. Yes, we were forecasting with a 24-month horizon. We are within the target band of 8 plus or minus 2%. And I think that we all agree that maybe this is the time to relook at the new central point, whether 8 plus or minus 2% should continue to remain the next medium-term target for inflation, or whether we could move it further downwards towards a lower rate of inflation. To the extent that our trading partners have inflation rates which is below 5%, closer to 2%. If you have a higher inflation, just from the inflation differential alone, you lose competitiveness. So yes, there might be a need to relook at the medium-term inflation target that we have set for ourselves in order to maintain the competitiveness of the Ghanaian economy. Question from our colleague at Daily Graphic on whether inflows are expected. Yes, as you know, every year we have new inflows. The inflows tend to be seasonal. As you know, every fourth quarter, third quarter of the year, we see more inflows than outflows. So 2019 will not be different from what we have seen in the past years. The seasonality associated with foreign inflows still shows that we will be receiving more inflows than outflows between the third quarter and the fourth quarter of the year. I think that addresses most of the questions that I have had. There is one here on the deposit protection scheme. Yes, we are supposed to get the deposit protection scheme started in September. As I speak, the office space at CD House has been put into place. The officers have been hired. They are getting the necessary softwares that would allow them. So all the operational things that need to be done to get the deposit protection scheme off the ground are, being steadily worked on. On foreign exchange rules, yes, the foreign exchange bureaus are reporting. We are getting more reports than before. And I believe that the disorderliness that we saw with unlicensed foreign exchange operators, boldly carrying out their trade in the public has reduced somewhat since the bank started enforcing the rules in that market. I believe I've dealt with all the questions that I've had. There was one question about exactly how much was spent to defend the currency. I think somebody asked that on whether all the 600 million went to, defend the currency. This is the difficulty about answering that question, is that the Bank of Ghana is also part of the market, right, as a buyer and a seller in the market. And these are real transactions of commodities which, you and I import, oil and non-oil imports. So when we go out there to, facilitate the import of oil or non-oil, it's not quite clear to me whether one can defend that as solely to defend the value of the city. It's very difficult to, isolate which portion of that transaction represents, balance of payment support or, moderating the volatilities in the market.
Good morning. My name is Kester Crunchy. I write for the graphic business. I wanted to find out from you what is being done about the microfinance institutions and the savings and loans. People are still crying. They are locked up. Capitals are in there. And we talk of a cleaned up financial sector. I believe that those components are also part of the financial sector. So if people are suffering with that, with those companies or those institutions, and they are not getting their monies, and the Bank of Ghana has not come up with any roadmap to avert that, can we be saying that we have a cleaned up financial sector? And also, I wanted to find out if we're going to have another cleanup after this cleanup, which will be expensive, like you said the other day, an expensive cleanup, which will be a cost burden on a taxpayer. Are we getting there? There are also rumors about the unsuccessfulness of some of the measures that is currently ongoing. Can you please update us on them? for us to know so that we wouldn't be deceived by somebody to write a wrong thing? Are we going to see them successfully done, or there are some hitches along the way?
Hi, Governor. Good afternoon. My name is Eko. I report for Bloomberg. In the immediate past, there was talk about your collaboration with the Energy Ministry to, as it were, set up a special mechanism for companies that do importation of oil products, given that the volumes of dollars that are involved in those transactions have some bearing on the exchange rates. What is the update on that? And then, two, you also with the bank set up some reference interest rate for banks. Are you considering a similar thing for the forex market too? Thanks.
Good afternoon, Mr. Governor. My name is Mandela Okan from the Trends News. The public debt currently hitting 173 billion, debt stock of 140 billion in November 2018, representing 24%, a growth within 12 months. With this current government high expenditure, what's the BOG doing to get the government to rein in this high expenditure? My second issue is with the recapitalization that ended December. May I know why Heritage Bank and the Premium couldn't join the Big Five for God to help them to recapitalize? Thank you.
My name is Dachi Hinofusu Ajimai from Power FM. You said the CD depreciating 8.34% did better compared to some countries. I went to buy some dollars last week and I needed $1,000. I sent 5,000 and I had to add 80 cedis to it because it was 5 cedi, 80 pesos. I tried dodging that place, but when I went further, it was 5 cedi, 10 pesos there. So I had to come back to the 5 cedis, 8 pesos. Any assurance or any message to the ordinary business personality? Thank you.
I wanted just clarity on you on the... No, it was just a clarity on a question. The bit about the CD. So do I get from you that because of you're watching your reserves, you would want to allow market forces rather to dictate the pace than any intervention? Because if you speak to the market players, you get the feeling that BOG is not active on the market. And also on you, with respect to your liquidity reports that you have right now, have you seen some improvement post completion of the cleanup of the banking sector, where things are picking up, funds are now flowing in, or still people are yet to respond to that confidence that we are looking forward to?
So, Governor, I had to go out and put a report out there, but my colleague Etonam asked a question that I had a follow-up to, and it concerns the failed banks that understated their liabilities, and my colleague Thomas Emery and his team put that report out there. I followed the economic data over the weekend, and I see non-performing loans gradually inching down. But then I question myself, so does it come with all the credibility? Am I believing that all the institutions currently operating, because this is pretty serious to have these institutions understate their liabilities. So am I to work with even the 18.2% believing? Maybe KPMG would have to go around and check all the others critically well if they are not doing it, because you wouldn't want to come back and have an 18.2% as of now not being the significant figure that you want to see. So kindly address it for us. Failed banks understating their liabilities. Really, those currently operating, could there be something wrong?
Mr. Governor, just a quick one. I just want to find out what's the total shareholders fund after the recapitalization of the 23 banks. Thank you.
That's just statistics. You can see the statistical table will give you the data on that issue on the equity. So let me take this last batch of questions. I think the first one had to do with the SDIs and what we are doing about SDIs. First, it's important to note that there are some very good SDIs out there. I don't want to mention names, so we don't have to, say that all the FDIs are, having difficulties with meeting depositor obligations. There are some that are doing relatively well, both savings and loans, finance houses, rural banks, and even microfinance institutions. However, we also know that there are pockets of these institutions that are distressed, and we have already committed to cleaning up those pockets of distressed institutions in the specialized deposit institutions. As you know, with this sort of cleanup costs money because you have to replace the depositors' funds. And we need to be able to mobilize the resources as part of the budget to be able to pay these depositors their funds. And once the government is able to put together the resources, we will commence with the cleanup of that sector. So it hasn't been forgotten. There's still work going on to try to identify the resources to do it. I must say, however, that we are quite clear that the interventions that were done with Consolidated Bank has eased some of the pressure for some of these other institutions because of the interconnectedness between the financial institutions. Because you had some of the banks that had, were exposed to savings and loans, microfinance institutions, and finance houses. Now, by providing liquidity to Consolidated Bank, they've been able to pay up some of the depositors of savings and loans institutions. They've been able to pay some of the depositors of pension funds and other institutions. And this is why we are saying that the intervention not only protected deposits in banks, it actually also impacted on deposits in the other financial institutions as well. Issue about mergers, I'm not aware of any merger that isn't going well. So if you are, we would like you to share your information with us. From all I know, all the mergers are going on very well. Question on the oil products. Collaboration with oil products because of the bearing on exchange rate. I'm not quite sure what you mean, but if you would recollect, we had a deregulation exercise in this country, and that deregulation exercise was to ensure that the oil transactions are done in a competitive manner. We were not going to be allocating foreign exchange directly for oil. Oil, just like any other import, would meet their foreign exchange requirements from the interbank market. And it has worked effectively since the deregulation of the sector. I don't think that we need to have a special foreign exchange arrangement for oil distributing companies. And therefore, we would not have a special reference rate for oil, if that is what you're trying to drive at. Because we don't think that that is the way to go. We want to see efficiency even in the, in the market for oil. On public debt, the increase in the public debt, I think there was a very clear footnote on the statistics that was public that quite a big chunk of the increase in the public debt could be attributed to the bonds that were issued to cover depositor payouts. So this was not this was not due to fiscal operations over the period. Government spent over 10 billion within a very short time to address these financial sector issues, and that has to be taken out of the assessments on whether this represents a fiscal spending or not. Any assurances on the exchange market? Yes. This is why we have a central bank. The Bank of Ghana is here managing the policy. The intention is to ensure that we have price stability, and with price stability, we should expect to have exchange rate stability. But to the extent that we have a flexible exchange rate policy and a liberal market, you will see day-to-day fluctuations in the exchange rate. But the objective is to try to keep the exchange rate and prices as stable as we can. We have an inflation target of 8%. That should translate into a very stable exchange rate for 2019 and beyond. And you have to look at it within the inflation targeting framework, which should set the bounds for the extent of exchange rate depreciation that one can expect. I think that we spent a great deal of time in this press release addressing the issue of the impact of the consolidation and how that consolidation has helped improve confidence in the market. The fact that you have taken out weaker banks, which represented a source of risk, and therefore you are giving the existing banks the ability to be more efficient at what they do. The fact that the system as a whole has more capital and therefore more buffers to withstand shocks. The fact that with the additional capital, these institutions will not find the single obligor limits as constraining as they were. And all of these things should enhance efficiency and allow them to be more effective, to play the role of financial intermediation in order to help the economy grow. So maybe we want to end on that point, that we think that the reforms that have been put into place have been very effective, and we should expect to see improved liquidity. You talked about improved liquidity. We should expect to see lending rates going down, because the weaker banks that were borrowing deposits at very high interest rates have all been removed from the system. On that note, thank you very much for coming.